Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kostrup-Larsen.
Welcome back to the latest edition of Top Traders Unplugged, where each week we take the pulse of the markets from the perspective of a rules-based investor. It's Alan Dunn here, sitting in for Niels, joined by Mark this week. Mark, how are you?
Not too bad. I was just in Chicago the last couple of days, and it was 60 degrees Fahrenheit, which for Chicago in February is quite unusual.
Very nice. Well, I'm in Dublin. It's been raining nonstop for about, at least 2 months, it feels like. So I'm off to Miami next week. Niels is already out there. Obviously, we've got big iConnections hedge fund conference, so a lot of people will be out there. So if you're there, say hello. But looking forward to that, and obviously, hopefully we'll see. I'm no doubt we'll see some sunshine in Miami. You would expect at this time of year.
I'm going to say that there's so many hedge fund managers in Miami, Florida this time of year. It's almost as though that who's minding to shop if everybody's down in Florida.
That's right. Well, hopefully it'll be a good week. I'm sure it will. Lots of meetings, and it'll be very busy. We always start off with what's on your radar. Anything out of the ordinary catching your attention at the moment?
Well, everything seems to be out of the ordinary in the last month since the beginning of the year, between all of the bubbles we've had, the craziness in geopolitics. So where do we begin? Hard to say.
Fair enough. Well, we'll get to all of that in a minute. I think it makes sense to cover off on performance before we get into the main topics. So on the month, trend following and managed futures continuing its recent good streak of performance. Month to date, the SocGen CTA index up 1.1%, and the SocGen trend index slightly better at 1.15%. And then year to date, pretty much neck and neck, both the SocGen CTA index and the SocGen trend index up 5.9% on the year. So it's obviously been a good period this month. Obviously, we've seen a bit of a dip down in equities, but continuing to see some decent moves on the commodities side, I would say. Obviously, gold higher on the month, and that's been a big trend in the softs, the likes of cocoa and coffee trending to the downside. Energy markets starting to move up. And then elsewhere, obviously, currencies probably a bit more choppy, and US bonds obviously moving up and trending in the last while. But obviously, it's been a good period, not just this month, last month, but for a few months. Mark, any thoughts on how performance has evolved more recently and in the last few months?
Well, it's interesting is that I'd like to say that after January, we may have hit, at least in the metals and maybe some of the other markets, what I'll call peak bubble. And when you think about it, is that we had the spike in gold and silver. We've had a little bit of a reversal. What's really crazy is if you look at some of the softs, if you look at what happened to cocoa in the last year or so, we've gone from a 12 handle down to 4. Which is just, and the same with coffee. It's just been a tremendous move. And this is what we see repeatedly with a lot of bubbles is that you could have a blow off top, then you might have some correction. And then sometimes they'll just slowly, grind lower. And this is where a lot of trend followers can make money on both sides of the market. Market goes higher. You take on a little of that speculative fever on the upside. Then if you can learn to get out at near the tops, then you can also play it on the other side.
Absolutely, yeah. And that's certainly the case, as you say, with cocoa, coffee, and obviously crude oil in that big move up back in the 2000s as well was another example of those kind of extreme moves. But Yeah, I mean, it's interesting, mentioning bubble, and I know you in your notes in preparation for today, you're talking about peak bubble. I mean, coming into the year and over the last few months, there's been a lot of talk about, bubbles in the market and tech stocks, etc. And obviously, a lot of the momentum has already come out of that. So, is this a pause, do you think, or are we in the midst of the initial deflating, do you think?
Well, it's hard to say because you have to go back to what causes bubbles in the first place. So you're going to need sort of the fuel, which is excess money, which I think we still have. But you also need a narrative and a story associated with a bubble. And
Hmm.
what we find with a lot of uh, bubbles is that it's for those assets that are very hard to value. Because if they're hard to value, then you could be able to get stories or narratives that lead to extreme price moves. Now, an interesting piece of research that studying it was talked about the uh, retail habitat. So these analysts have looked at retail investors and sort of said, what seems to be their characteristics? So one of their characteristics is that they actually gravitate to hard to value stocks. So stocks and other assets that are hard to value, then if they have an optimistic narrative, then they could lead to sort of extremes. So that's what we sort of see with a lot of tech stocks. If you don't know how to discount the future cash flows from these firms, then it's harder to value. You could be extremely optimistic, and that leads to bubbles. In the commodities markets, I think we're in a different situation. Is that uh, people sometimes forget that a lot of commodities, especially if it's not an annual crop, is that there's supply constraints. For mining, for example, supply constraints. So if you have some optimistic euphoria, whether it be in silver or gold, where are you going to get the supply? The supply is constrained, so you could have these demand shocks, and that's what we've seen with the gold market and the silver market is that we're not going to see new supply, and in fact, we'll sort of say some of the discount in gold from the high is just related to the fact that there are fewer retail investors right now because of the Chinese Lunar New Year.
Okay, interesting. Well, as you say, gravitating to hard to value markets certainly makes sense. The tech stocks, crypto, and obviously there's been a lot of retail participation in the gold market of late. I was looking at some data there from the World Gold Council, and they were highlighting, obviously central bank buying has been an important theme, but it's been less. It was less in 2025 than in 2024. And certainly ETF flow was very much the dominant driver in the latter part of the year. So that's very much consistent with, much more retail participation. And obviously, as prices rise, that encourages new entrants into the market. So I think that's definitely fair there.
Where the central bank issue is very central to gold markets, and we'll talk about this a little bit later when we talk about the U.S. dollar and U.S. assets as a safe asset. This is that those countries that feel as though that there might be a potential risk of sanctions have been bigger buyers. Their central banks have been bigger buyers than other central banks. So we'll say China has been a big central bank buyer. Some of the other countries that we know that are worried about sanctions from the U.S. have been bigger central bank buyers. Some are on the periphery of where there could be war, like Poland has been a big buyer of gold, and so we'll sort of see that this is serving as a quasi safe asset. So if you have foreign reserves, or if you have your excess reserves, if you're a central bank, you say, well, if I don't want to put in dollar, where else can I put my money? And you say, well, if I diversify, I should put some in gold. This is
Yeah.
what we've seen has changed.
Yeah, no, for sure. And you're right. I mean, the data that I looked at, I think it had the National Bank of Poland was the largest buyer in that period, and also a lot of the former Soviet countries ending in Stan, places that are hard to pronounce, but they're not just Uzbekistan, but other places like that. So that's certainly consistent with what you're saying. Now, interestingly, you touched on narrative there, which I think is quite interesting. And obviously, something that we're seeing in markets at the moment is a shift in the narrative around AI. If we went back, 12 months, maybe, AI was seen as a positive influence. It's going to change the world. It was all positive. More spending was a good thing. It was going to benefit the likes of Nvidia and all of those kind of chips and infrastructure providers. Obviously, that's shifted as we've come into this year. We've had the SaaS apocalypse. I struggle to get that one out. The software sell-off, and I suppose more generally, that shift in the narrative to the fact that clearly there will be winners and losers from this AI revolution. That's one thing. And then secondly, obviously, in terms of market reaction to earnings numbers and, the releases about the amount of CapEx spending around AI. So just curious to hear your take on that shifting narrative. I mean, what does that suggest to you in terms of, is that, symptomatic of more of the end of this move, or just a different transition, a different phase of the move?
Well, let's talk about what I mean by the word narrative. So when we say the word narrative, all the time we say, well, we think of it as a story, which is true. But I think that narrative is the use of storytelling when we don't have what we'll call countable risk.
Mm.
So let's say that there's a difference between risk and uncertainty. So a risk is something that's measurable. I can count it. So that would be our volatility. So if you say, well, what's the volatility market? You say, well, let's look at the VIX. Okay, it's something that's countable. I could, even though that's a market expectation from the options market. So, but then there's an uncertainty. Is that which is not countable? Okay, because I
Mm.
don't have any past events I could look to. So when I think of AI and the AI revolution, is that since this is new technology, I don't have a way to actually measure the countable risk. So therefore, I'm in the realm of uncountable, which is uncertainty, and therefore I have to use narrative. And then when I use the narrative, I have to come up with a metaphor or story for what I think might happen in the future. And in this particular case, is they'd say like, well, I have to discount sort of say the potential use of AI in the future, and we'll sort of say that AI is revolutionizing a lot of our behavior. It's going to revolutionize a lot of businesses. It's going to increase productivity, but is the growth going to be what is embedded right now in expectations? Or is
Mm.
it going to be a little bit lower? Is it going to be a little bit higher? And because we can't sort of count that, that's where the narrative issue comes in, is that you could have a very optimistic narratives and then discount the price with those values. Or it may be something in between, a failure and these overly optimistic forecasts.
We've kind of fallen into more of a rangy market, particularly with respect to equities in the last while. I mean, if you look at performance, say, over the last four weeks or so, bonds have actually gone up, equities have come down a little bit. You had the kind of the escalation of the run up in metals, and then a correction. Currencies have been rangy. So nothing, I suppose, underneath. Maybe the big theme has been the rotation in markets. Is that probably fair to say?
No, absolutely. And I think that this is where, when we talk about what are the major themes in the marketplace, we'll sort of say that rotation is probably the major theme for 2026. And so the rotation has been out of the U.S. into European and global stocks. It's been out of U.S. bonds to some degree. Or now, when we say out of bonds, we want to be precise. There's been a lot of buying of U.S. bonds, even by foreign investors. But at this particular time, a lot of them are now hedging those bonds as opposed to unhedged. And we see U.S. pension funds flows moving from the U.S. and to outside the United States. And so that's where the rotation comes in. We're seeing the difference in, software companies have fallen, more real asset companies have gone up. The AI stocks have fallen also, and then we'll sort of say that there's been more buying across a diverse set of companies than what we saw in 2025, where everything was more concentrated.
And I mean, one of the interesting features has been, if you look at it from more of a sectoral perspective, you've seen maybe industrials and materials, which would be kind of typically seen as cyclical sectors, doing well. And at the same time, consumer staples doing well, which would be typically more kind of defensive stock. So, I mean, from that lens, a bit of an inconsistency. I guess we are seeing a rotation out of growth into value. But I mean, is there, I suppose, a coherent story around that narrative, apart from, okay, I hear what you're saying about out of the US into Europe, which is underpinned by a fairly obvious kind of story. But the other rotations, what's driving those, you think?
Well, let's go back to some of the facts that we sort of see. One is that, I'll be leading the witness. Is that, what do you think of the U.S. inflation relative to emerging market inflation? Which do you think is higher or lower right now?
Well, you wouldn't guess US, but I'm guessing this is a trick question.
So that's it. It's sort of a trick question, but I found this very amazing that if you look at a basket of EM countries and then you look at their inflation, it's actually lower than U.S. inflation even now. So obviously, U.S. inflation was peaking after the pandemic. But what we'll sort of say that even now is that the U.S. inflation even at around 3% is, our core inflation is higher than what we're seeing in emerging market countries. So this is a really big theme, because what that means is that EM is much more attractive than the U.S., just from the inflation story. Okay, so that's going to cause a rotation. So if you see that kind of behavior going on, then you have to say, well, what's really going on? And I think that the major theme that I see is two factors: is that we have this K-shaped economy, where we have very difference between the real economy and then the asset economy in the U.S. And that's being played out in the behavior of assets such as stocks and bonds around the world.
And I mean, you touch on the EM inflation versus US inflation. And I guess one of the upshots of that is that real yields in EM are higher and more attractive than in the US. And I mean, I suppose, linked to this is, I suppose historically the EM had a premium because policy was less credible, central banks were less independent, etc. They weren't as rigidly pursuing inflation targeting. But now everything is shifting. They're kind of more adhering to those inflation targets, whereas credibility is maybe diminishing in the US. So I suppose, is that relative attractiveness of US versus EM shifting?
Yes, I think there's the attractiveness is shifting, and we'll just sort of say that part of this has to do with the major story of uncertainty. Now, I follow pretty closely. We have trade uncertainty indices. We have geopolitical uncertainty, monetary uncertainty. Now, some of those have peaked in the fall, and some of them have come down. But let's say trade uncertainty is still at very high levels. Overall uncertainty is high, although it's come off its peak. But when there's more uncertainty in, let's say, a G7 country, or in particular the U.S., that's going to have an impact on whether foreign investors or even U.S. investors look at U.S. as a safe asset. So that's on one level. And also, if there's more uncertainty, it's say like, well, I'm going to need a premium to hold a risky asset in a high uncertain country versus a less uncertain country. And so we're also seeing sort of flows going out there, because you say like, well, maybe I could discount those cash flows better in other countries than the US right now.
Just on this EM issue, I mean, is this a structural change, do you think, or are we just at a point in time where this is a sweet spot for EM? And I'm kind of thinking in terms of the overall regime that we're in at the moment. Obviously, it's a changed economic regime from what we were in the 2010s, which was secular stagnation. Obviously, we're in a higher nominal GDP environment, or more inflation uncertainty. There's various features from an economic perspective, but we're also seeing this shift in the relative attractiveness of EM debt versus a developed or particularly US debt. But could EM sovereigns be seen as the new safe assets, really? Or once we get to the next crisis, will all of this unravel?
Well, I'm spending more time thinking about the concept of a safe asset as a relative concept as opposed to an absolute concept. I think a lot of people, when they think about a safe asset, well, they've always viewed as the U.S. dollar or treasuries as a safe asset, and then it was as absolute. And I think now we have to think of safety as a relative concept. Is that you could still be a safe asset, the U.S. Treasury, but it might be less safe than it was a year ago or 2 years ago. So consequently is that if there's your relative safety has gone down, even though on an absolute basis you're safe, then that means that people are going to diversify more of their asset flows. Have we seen a fundamental shift in EM? That's probably not my area of expertise, and I think that those are longer term structural changes. But we do see a situation is that the relative safety or the view of the relative safety of U.S. assets has fallen.
Yeah, fair enough. It is something I've been thinking about. You do hear this comment sometimes, oh, bonds are not going to diversify equities anymore. Look at the bond equity correlation. But it's very definitive when you say it like that. Whereas I don't think that's the case. You can certainly envisage certain scenarios where we have crises, the Fed cuts rate aggressively and bonds rally while equities go down and bonds do diversify. So, I would think it more, as you say, like kind of less safe or less reliable as a diversifier, but it's not yes or no. It's more less so than in the past.
Well, this is the key overall theme is you say like, obviously I'm trend follower, a strong believer in trend follower, but also global macro guy. And the reason why I am a global macro person is because I think we go through regime changes, or there are different regimes that we might be in where relationships change through time. And by being aware of, we'll call it the, regime changes, or how all of our analysis is conditional, then you might be able to get an edge on how you should form your portfolios or where you think that the opportunities might exist. Now, I was going to start with a quote earlier in our podcast. This is that was from Peter Lynch from Fidelity. This is and I worked for Fidelity for a number of years, but and I don't believe this quote, but I thought it was a great one. He said that if you spend 14 minutes on macro, then that's 12 minutes too long. So I don't know if I will actually believe that. I think you should use the whole 14 minutes or maybe more to spend time on macro. But I think that there is this view is that you don't need to know what's going on in the global macro economy. And I'll take the opposite point of view is that we do need to do this. That has a big impact on all types of assets, because most of our asset price relationships are conditional on the environment we live in. And, let's give a simple example. There is an interesting paper I was looking at is talking about stock beta. And then if you just look at, what is the beta for an individual stock, or what is the beta for, a given asset? And once you break it down into, different regimes, whether we're in crisis, non-crisis, recession, non-recession, is the concept of a beta for a individual stock is a fairly fluid one. This is that, and I remember one discussion I was having when I was at John Henry. He said, like, what's the beta for the stock? And I said, well, it's it's this, but if we measure it differently, we'll get a different beta. He goes, well, what do you mean there's a different beta? He said, there should be one. What is the beta? And I said, like, well, there isn't a beta. There are many betas, because it's like his hands are, thrown up in sort of frustration, and say, like, I ask you a simple question. Can't you give me a simple answer? And the answer is no, that there are no simple answers. Now, that could just be because I'm an economist and there's always on the other hand. But in some senses, is that a lot of our relationships that we see are conditional. And that's why we have to spend a lot of time looking at different regimes, looking at different environments, because that's how we create an edge.
Yeah, no, fair enough. I agree with you. I mean, Peter Lynch was a bottom-up stock picker. So, I mean, in terms of how he ran money, obviously hugely successfully, he wasn't a macro-oriented investor. But I think for the rest of us, if we're thinking about portfolio construction, certainly good to be cognizant of the macro picture and the regime changes. But just on the regime change, I mean, we always talk about it, that there's a regime change underway. And I think you can certainly paint that picture, as I say, with secular stagnation in the 2010s, deglobalization, all of that, falling inflation targeting, etc. All of these things that have changed. Now, you could look at the equity market and you wouldn't really see much evidence of a regime shift. It went up back then. It's still going up now, so nothing there. But it is curious to think about what are the elements where we're seeing that change in the regime. And so the bond equity correlation is obviously one obvious example of that, and that was very much in 2022. I guess another one is maybe the US dollar. Going prior to Liberation Day, the dollar was kind of strong on talk of tariffs, and it was rising on relative interest rate differentials. And since then, that relationship has been weaker. And obviously, you could say there's some kind of negative premium or a discount or whatever being applied to the dollar, maybe on the basis of credibility, etc. And maybe gold is the flip side of that. Historically, you would have explained it in terms of real yields and the dollar, but obviously it's been accelerating in the last kind of 1 to 2 years, independent of those factors. Driven by central bank buying, ETF buying, etc. I mean, anything else you look at, or any other signs that you see that point to that are evidence of that regime change? Do you think?
Well, we can think of regime change on a number of different levels. So you can think of regime changes and use sort of techniques called hidden Markov processes to just sort of say, like, well, are we in a high vol, low vol regime, or risk on, risk off regime? And I'm not saying that those are easier to forecast, but we could sort of say that's very data dependent. And so we do find is that, for example, is that if we're in a higher risk regime or a higher risk environment, that the behavior, different strategies and tactics are different than if you're in a low volatility regime. And we also do know, and in particular, let's look at the VIX. This is it. What you find is that the VIX is a very skewed distribution. And we do find is that once it gets above like 25 and it's moving higher, so it's above a certain threshold level and moving higher, this is that it's bad news for a lot of assets. So and then if it gets to above, around 40, whatever, then we know it's sort of peaking, and then we know it's going to come back the other way, and that's good news to get back in. So, so there's a nice nonlinear relationship, and we could use sort of like techniques to look at high versus low vol environments. So we could do that. There's also regimes when we think about the environment, what type of monetary environment we are in, what type of fiscal environment we're in. So, and we could think about, the view of geopolitical. If there's high level of uncertainty, that's going to change the demand for safe assets. So we'll call it the, price-driven regimes. There's policy structural regimes. There are sentiment regimes. So we can decompose these different types of impacts. And so, in a simple podcast, we can be flip with our definitions, but when you look underneath the surface, is that you have to decompose this into a lot of different types of regimes, and that's where this is where you could be able to create your edge. So by, sort of decomposing the kind of regimes that you're in. Now,
Yeah.
we do know, for example, the stock equity correlation regime, which is usually negative, is that inflation goes up, that usually then that stock bond correlation is also going to go higher. So it's inflation dependent. So you can use sort of third factors to give us some indication of what kind of environment we're in. And why do we want to look at that? Because if, let's say, that the stock bond correlation changes, well, that has a big impact on what type of alternatives you want to buy. Is that if the stock bond correlation is negative and highly negative, and rates are, reasonably, high. Let me put it this way. This is that I don't really need to buy alternative strategies. But when that correlation starts to go positive and rates are lower, they say like, well, that's a great time to own a lot of hedge fund strategies or other types of strategies. So that's a perfect example where we could use sort of regime analysis to help us build portfolios, how we look at it. And then from a, we'll say a more micro basis, is that we know that when we build portfolios, even based on trends, the correlation relationships may have a big impact on the kind of risk exposures we have. So knowing the regime that we're in could help us, on the margin, change our tilts and our exposures to make sure that we're not overexposed to one sector versus another.
One of the topics you touched on there was the kind of the monetary regime, and I think you might have mentioned the fiscal regime, but certainly we're into an era now where, there is a lot more talk of possible fiscal dominance. I mean, people have been throwing around the term fiscal dominance for a while now, as if we're here already. We're not. I don't think we are quite there yet, but it is obviously a risk, because fiscal dominance is when the debt and deficit levels are so great that they are dictating monetary policy. I know the pressure is on monetary policy at the moment, but we're not quite there yet. But I mean, taking that angle, that lens, I mean, what would you say about the regime now versus where we were from a kind of a fiscal and monetary dominance perspective?
Right. Well, I think that this is this issue of, or at least trying to frame a lot of the discussion about Fed independence, frame who is going to be the chairman of the Fed, frame, how, so the tussle between, let's say the current U.S. administration and the central bank, has to be looked at through the idea of fiscal versus monetary dominance. And so, of course, there's a political agenda going on here, but I think sometimes is that we have to take ourselves away from the politics and look at the economics and try to say is that what causes the tension between the Fed and the Treasury Department. And so we'll try to take out the administration. We'll call it Fed versus Treasury. And this is the issue of fiscal versus monetary dominance. And in a monetary dominant environment, we'll say the Fed could focus on, or the central bank can focus on inflation, employment, regulation, and the fiscal focuses just on financing. They say, look, where can I minimize the cost of my debt? That's all I have to worry about. Say the Fed could do whatever they want. And in fact, the fiscal side or the Treasury could sort of say, yeah, you could follow whatever you're doing because your objective is full employment. We're just going to then try to pick on the curve where we want to issue our debt. And we're going to finance our deficits, which we don't think are going to be persistent, and everybody's happy. Okay. If we have to go into a fiscal dominant situation, well, then, the government, and we'll sort of say that even the central bank, even if they're appointed for a long period of time, they're still authorized, or there's oversight by Congress. Fiscal dominance says that debt is so high that the central bank, or we're going to put pressure on the central bank to use its powers to control interest rates and then buy up excess debt. And so like, well, is this abnormal? Should be shocking? Well, we look at World War II. The whole idea is that the Fed kept interest rates low because we were financing huge deficits to pay for the war. and then they're actively buying treasuries. So this is what happened in World War II, post World War II, and then we had the Treasury Fed Accord. The Treasury Fed Accord said this is that, well, now that we're going to split the Fed and Treasury working in tandem to lower the cost of financing, because in effect of doing that, you raised inflation. Now we're going to allow them to sort of move in different directions. So now what's important here is there had been another recent paper about debt, and then they talked about debt as a safe asset. So like, well, that's true, except if we're having a war. Then if you buy debt, and if you're in a war scenario, because there's a lot of financing of wars, and then there's usually inflation because of perhaps pent-up demand after the war ends, is that you don't want to be a debt holder. And what these authors actually said is that the pandemic had all the characteristics of a war. Okay, we had constrained demand, we had excess monetary policy, we sort of drove down interest rates, we had excess fiscal policies to sort of offset the war on the pandemic. And so what happens when we came out of that is that, well, that's why we had a sort of inflation burst, because of the excesses of fiscal policy. And so when you think about it, is that the excesses from that pandemic war is now we're still having that issue today, because in some sense is that we should have said like, well, all of those spending was temporary. So we should have seen a big budget deficit increase. Now that the pandemic is over, we should have reversed all of that. If you don't reverse that, well, then you have a problem. And this is where now you have the tussle between the monetary and the fiscal side.
A lot to get into there. Yes, as you say, you've got this tussle, and as you rightly say, I mean, COVID was treated just like a war. I mean, that was the kind of narrative at the time, and I think in the UK, there was actually direct buying from the Bank of England of bonds issued by the Treasury, whereas in the US it wasn't direct buying, but it was all but in name. I mean, the Treasury issued more debt, and the Fed did more QE, and so they didn't finance it directly, but effectively they did. As you say, we had a surge in deficits which haven't been addressed since then. I mean, looking at the precedent of, as you say, the 1940s, the justification at the time is obviously to try and keep debt financing costs down because you're in a war. It's also a form of financial repression, of course, as well, isn't it? Because obviously you pin down long-term rates and you allow inflation to be higher, so bondholders experience negative returns. And then ultimately, in that scenario, the Fed did flex its muscles again and demand its independence back. And that's why you had this kind of standoff between the Fed and the Treasury, which ultimately resulted in the Fed Treasury Accord, and the Fed got its independence back. So this is all relevant in the current context, because people are now saying you've got Kevin Warsh and you've got Scott Bessent, both linked via Stanley Druckenmiller, interestingly enough. But they obviously already have spoken about a possible new accord. But I mean, they've spoken about it in some kind of positive light. But I mean, would that be, should we interpret that as more financial repression, or what do you think that might look like?
Well, here's where the situation we're in right now is that we'll sort of say that the current Treasury Department would love for the Fed to lower interest rates. Because that lowers the cost of debt. And you could use that instead of paying off interest, you can use, that money for other purposes. Is that it could be used for other expenditures.
Yeah.
So you have the desire to do that, and you sort of say, well, if you can't default on your debt, what's the easiest way to reduce the value of your nominal debt? This is that if you have inflation. So So you have a Treasury that would sort of say, I'd like to have lower interest rate to lower my financing costs. I really don't mind if, let's say, there's a little bit higher inflation, even though they'll never say this, because that reduces the real value of the debt. So, and we'll sort of say then you have, we'll call it this K-shaped economy. And if you look at, some of the data on the employment side, you can sort of say that I may want to be, if I, as the current administration, I may want to run an economy hotter because I don't believe the data that I have. And a perfect example is that we just had in January the revisions for employment. The revision for employment said that there was probably a million fewer jobs created because we changed the benchmark rating. Year before, we actually did a seasonal adjustment and we got like lower job production. So if you sort of said like, look, we didn't create a million jobs in the last year or so. This is that the economy may not be doing as well as we expect on the one leg of the K. So you may want to say, I want to run my economy hotter. Now, you could also say that these benchmark revisions was caused by demographics. And so if people are moving out of the United States, we'll call that euphemistically, they're moving out of the United States. So and you have less people in the workforce, well, then it may not matter as much. So we don't see the unemployment number going higher. But you'd say like there's this tussle between fiscal and monetary policy because we do have, these competing interests. Now, the interesting part and the reason how we get back to this recurring theme of always uncertainty is that Warsh has said is that he never really liked QE in the excesses of what we had. So if he actually follows through on what his behaviors, he's going to reduce the amount of Treasuries on the Fed balance sheet. That's reducing the overall liquidity. That's going to cause a major deleveraging, which should have an impact on asset markets. And at the same time, is that it's exactly what the Treasury does not want them to do. They like the fact that the Fed has a large balance sheet. And we'll say, like, look at the size of the financing. This is that, again, Alan, I throw out these questions just to be provocative. You're going to, it's not the obvious answer. Like, how much debt do you think the U.S. actually issued just last week? Just take a guess.
No, $500 billion or something.
So you're close, but you're still off by about $200 billion. So in 1 week, the Treasury that we had sort of like some quarterly refinancing with this is it, and not all of this was new money. Some of this was rolled over, but we did like a $700 billion of Treasuries being auctioned in 1 week. Now that was between bills, 2 years, 10 years. So it was along the entire curve. So, but that's a huge amount of money. This is it. Now the world can absorb that kind of stuff. But if let's say that there was a change in people's buying habits for Treasuries, that's a big number. And so and when you think about in 1 week, you could do that. Then you look at the size of the balance sheet. That's a pretty good portion of the entire Fed balance sheet. Now, again, we have to look at what is the net new money, and then what is this total demand from a number of different sources, and you can cut, sort of overnight repos. So there's ways to do this, but that's a big number, and that should give people a sense of, what we're dealing with in terms of the size of the issues.
Yeah. Well, as you say, the demand is there for it at the moment. I mean, you'd have to look to see where it's coming from. Obviously, that's shifted over time. Maybe it's less foreign. I mean, and also they've talked about changing the SLR to make it more attractive for banks to hold it. So there are things, but I mean, coming back to Warsh, I mean, his idea is the smaller balance sheet, but equally lower rates. And then I guess the flip shot of all of the upshot of all of that would be maybe more T-bill issuance to take advantage of lower short-term rates if that's how it played out. But one thing, I mean, that we're missing in this, we're talking about fiscal dominance, and central banks are only targeting inflation, and now we're talking about them no adjusting rates to target, to be cognizant of debt. But of course, that forgets about asset prices. So if we had this scenario of, the Fed, being more cognizant of debt considerations and lowering rates for that reason as well. Not only could it be inflationary, but presumably, as you say, it would run the economy hot and potentially fuel asset bubbles as well, which is another part of the discussion from the 90s that is getting lost in the current debate, I think.
Well, let's go back to what we started with. We always talk about regime changes. So first, this could be a regime change. This is that if we get a new Fed chairman, because he might have a different view. Now, let me put it this way. There could be a regime change because he has the view that is consistent with what he said he is interested, which means is that we have a lower Fed balance sheet. We could say we could also have a regime change is that he's going to sort of follow more of what the Treasury Secretary would like and allow for fiscal dominance. That's a different regime change. And the other third will sort of say that if we just continue to follow the path of these large deficits in the U.S., and probably the most interesting piece of research in the last couple of years in the macro side that hasn't got as much attention is John Cochran from the University of Chicago, is now at the Hoover Institute. So he's written about the fiscal theory of the price level. And so he said, well, if we really want to look at this shock to inflation, post-pandemic, we have to look at it as it's a fiscal theory of inflation. It's not a monetary theory. Now, the two of them were working together, but his view is that you're going to get inflation because people are going to take their money out of, they're going to start to buy real assets as opposed to, debt assets if there's the expectation of permanent large deficits, or we'll call it negative surpluses on the fiscal side. So that's going to lead to inflation. So what are you going to do is that you're going to put your money into real assets, which we've seen in the gold. If we say that you're going to put it in other financial assets, we're calling this sometimes a bubble, because if, let's say, too much of it goes into one type of assets, but generally financial assets are being bid up because people don't, sort of feel as though that, they may have excess savings. They may not want to buy real assets, or they purchase goods, so they're bidding up financial assets.
Yeah, I mean, it's interesting because if you go back to last summer, I think it was, Kevin Warsh gave an interview on CNBC. He talked about all of this. He kind of talked about the Fed being slow to raise rates in 2001, 2022 has been I think it's the biggest macro forecasting mistake in 40 years. And he talks about a need for regime change. So he at the Fed, and he also blamed, he saw the Fed as being complicit in the deficit expansions that we've seen because they've effectively financed it. And he had a definition for inflation of something like inflation happens when the government spends too much and lives too well, or something like that.
Right. That would be
which is consistent with the Cochrane perspective.
Yeah, this is consistent with this. So let me put it this way. It's possible is that if you get the Chairman Walsh of his comments over the last 10 years, we'll sort of say the current administration may have no idea what they're really getting if he's the person that they choose and he follows through on what he says he's going to do. We're going to be in a very different monetary regime, because we're going to be cutting back our the balance sheet. You could sort of say there's going to be a different view on how we're going to look at interest rates. And we say that may not be inconsistent with what the Treasury Secretary would like. And so when we talk about uncertainty, and then we talk about, okay, why might you want to be a trend follower? Why do you follow certain strategies? This is it. I don't think people fully appreciate the amount of uncertainty they could have if, let's say, it's almost as though that uh, at different times you see people in government and you say, like, I'm surprised by what he did. And if you said, if you just read his speeches and you read what he said, you might have a pretty good idea. And you'd say, like, this is not what you were expecting.
Well, there are different views in this. There is the kind of as you say, that's a very literal reading of what he's saying. But he has also said that he believes in the disinflationary effects of AI, and he sees scope for lower interest rates. So presumably he was emphasizing those comments when he was doing his interviews at the White House. But there's also, have you seen those charts that show whether he was dovish or hawkish, depending on whether it was, Republicans or Democrats in
Right.
power. So there is a suspicion that he might be a bit more political than maybe than other central bankers.
We'll say Wall Street and many, voters actually sort of project what they would like to see in a candidate or on someone as opposed to what they see as reality. And sometimes they actually then respond to what they think that, their constituents want. So,
Yeah.
so we'll just sort of say there is uncertainty here because we don't know what Orsh we're going to get.
Yes.
I think that you often see this with Supreme Court justices is that that's not the current court. But if you look historically, is that there are a number of Supreme Court justices that have picked and there is assumed that he was going to behave a certain way. And then we say, like, after he becomes the justice, his behavior seems to be significantly different than what they thought that they were getting. So this is the kind of uncertainty we have. And so what we're saying, be prepared for something that may be different than what you're reading about in the newspapers.
Yeah. That's fair enough. Maybe moving it to more of a quant model trading perspective. Obviously, this is more qualitative, but obviously, as you say, when you do get a regime shift, you could get shifts in relationships that would be relevant. So how do you think about, and obviously the Fed is at the heart of the financial system. So if there was a change in how the Fed is operating, whether it's a shifting towards less balance sheet, more active on the interest rates, or if it's fiscal dominance, whatever it is, that could have pretty widespread implications. So how do you think about that when you're maybe building models?
Right. Well, one is that we've talked about that you want to try to pick up regime changes. So when we know we have the technology to do that. So if we sort of see that using, let's say, the hidden Markov processes, we can be able to sort of say if asset prices start to delink or have a change in behavior like in volatility, we can pick that up, and so we can adjust for that. We also know is that there are breakpoints in data sets. So we have technology to what we call change point detection to sort of see if there's a change or break in a time series. So now what we could have is now, of course, you're never going to pick a peak or a trough in a breakpoint because it has to break before you actually then pick it up in the data. But that being said, is that if we're sort of aware that there's these structural changes, then we could be more sensitive to when we look at the data to see if there's a break point. So what does that mean? Is that one of the things that I've been work with my friends with firm we're involved in is Zunthor, is that we're looking at the connections across markets. We think of the markets as a connected system. We think of it as a network. And so what we're trying to look for, what are the causal relationships between markets? And then sort of say, like, how have network connections changed through time? And if we see that there are changes in network connections and we're willing to accept or or adapt to these changes, then it's more likely that we could get ahead of it. Now, any type of trend following, any type of quant model is always sort of looking into the past. Okay. So the question is, how fast can we react to the past data, or how can we sort of react to these changes as they occur? And one of the advantages of having a macro view is that when you start to see changes, or we expect changes, we could then be more sensitive to say, is there something going on in the data that we should be aware of, and we're a highlight.
Yeah. So, I mean, is it a case that you would see a shift that is consistent with what you're expecting from a macro perspective? Is that it?
One would hope that it's consistent with what we see in a macro perspective. But what we're finding is that, and we'll sort of say that this is one of the key issues that we're seeing in economics in general, and especially in finance, is the issue of trying to identify causality. So this is the number one issue in finance now. And we'll sort of say that ADIA had their labs had their causal discovery challenge, where they sort of said, like, you could use different machine learning to look at sort of finding causal relationships. But the reason why this is so important is that because over the last couple of years, what we have is what we call the factor zoo, that, you look at enough data, everybody's finding all these new risk premiums or risk factors in the data. And then what you find out is that you find them in the training set, or you find them in past history. Then we look at them in the future and they no longer exist. So there was sort of spurious causality, or we were trying to find something that we overfitted, or we found something that didn't really exist, or it only existed temporarily and then it disappears. So now I said, like, well, look, if we're having this, we'll call it the factor zoo, we're finding also is that, well, what we find in the data sometimes doesn't persist through time. Well, maybe we got to go back to square one and say, let's look for what are the important causal agents. Let's look for causal factors, and then make sure that, see if our models are consistent with the actual data. Or can we find causal relationships that we need to rethink our models? That this is going to improve the amount overall science for quant modeling.
Interesting. I mean, in the current context, where is that relevant, do you think? Or what are the ones,
We'll say
where is the causality uncertain, would you say?
Well, we'll say this is a work in progress, because
Yes.
because what we'll sort of say that when we've analyzed some of the interesting work in machine learning right now is that they've done some testing and some research where they said, like, well, is it the number of features we look at that gives us value added, or is it the complexity of our models, so linear versus nonlinear? And the machine learning world says is that, well, we want to add more complex, sort of techniques to try to tease out relationships in data. And what some of the research is now telling us is that it's not the complexity of the technique that matters. It's the number of features that we have, or it's the domain knowledge we have that actually adds more value. So that, that if it's an arms race of choosing, more complex machine learning techniques, we may not get as much value. So we talked about peak bubble. We'll sort of say that for different techniques, there's a while is that everyone thinks that this is going to be the new holy grail. And then in reality, what we find out is that it's a lot tougher to come up with a new model solution than we thought. Another thing we find with machine learning is that, for example, is that machine learning is very good on stationary data. So, and I'll use the analogy, if we're using machine learning to look at visual interpretations of, can we find a picture of a dog? So
Yes.
we show 100,000 pictures of dogs. Is after a while it learns how to find a picture of a dog in a photo. Okay. Well, if the dog is changing through time, its characteristics are changing like a market. that we find that it's a lot harder to do this. And so a lot of the techniques that have in machine learning that have been very promising in different areas of science, which has very stationary data, it's been very successful. When we apply these techniques, when we're looking at time series data, that seems to be more follow an adaptive markets hypothesis, which is what Andy Lowe developed. Well, we find that agents' behavior changes through time. We find machine learning is a lot harder to sort of, increase its predictive power. So markets are complex. They're non-stationary. They go through regime changes, which means is that the quest for finding the perfect model is ongoing, and we still haven't solved it yet.
Very good. So, I mean, it comes back to robustness, doesn't it? I mean, obviously what you're suggesting is you can't overly optimize given the complex adaptive nature of the system.
So, and when you think about, okay, for your listeners and for a lot of modelers, you say, well, should I tool up for machine learning? On the one hand, the answer is absolutely. You got to know what's going on in AI. You have to know what's going on in machine learning. At the same time, is that your benchmark standard should be more simpler models. So I don't want to sound like I'm talking out of both sides of my mouth. I say, like, I still believe in trend following. It still seems that it works, especially in uncertain regimes, especially when data is non-stationary. At the same time, as they say, like, well, how do I always try to improve on that? Because so many people are already trend followers. So many people are already using similar models. So you're always trying to say, like, how can I look for some small improvements that's going to differentiate myself from everyone else and also give me a predictive edge? The problem comes in is that on margin, it's sometimes hard to do that. Now, when we say it's hard to do is that just when I think that you've solved it, come up with a better model, markets may change slightly and they go through periods of, strong performance, then you get delayed performance or a fall in performance and it improves. And that's even finding for momentum and trend following. There are periods that when it does really well, then it might period where it wanes in performance and it goes back. And this is what we've seen throughout history. So right now we've had a good performance and trend following. Will that persist? Well, I could sort of say over the next 5 years, I could still be a believer in momentum and trend following. Over the next 5 months, that's a little bit harder to say.
Who knows? Well, we'll be here anyway to evaluate that over the next 5 months. So we shall see. But yeah, thanks very much. Oh, thanks very much for your thoughts, Mark. Great to catch up and get your perspective on all of that. I'll be back again actually next week. I'll be back from Miami in time to record with Jem. So if you have any questions, please get them into us. But until then, from all of us here on Top Traders Unplugged, stay tuned and we'll be back again with more content.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.